For this week's Your Money Questions Answered video, I took a question from my newsletter subscriber, Veli. And Veli had a really interesting question to put to me. And I think it's an important point to raise when it comes to taking out life cover and the affordability of life cover. So he says, I'm 67. I've paid for this policy for over 20 years. It's now worth a couple of million rand. If I die, it gets paid out a couple of million rand. But the premium increases every year and I can no longer afford it. I'm currently sitting on paying 3,000 Rand a month. But if I cancel, I lose everything, all those payments over the last 20 years. And this is such a critical point to make around life cover and the way that life cover has traditionally been constructed. So I'm going to talk about 2 points here. One is age-rated premiums and the other is term policies. So age-rated cover or premiums kind of came out probably around 20 odd years ago, which was a way for insurers to make life insurance a bit cheaper for younger people. Because what it did is it said you will pay the premium based on your age risk. And obviously when you're 25, the risk of dying is a lot lower than when you're 67, as Veli's age now. So your premiums are substantially lower, but they go up quite significantly each year, or especially as you age. And this makes it can often become unaffordable, which is exactly what Veli's finding. It's now becoming unaffordable. So age rated was great to get young people buying insurance, but it becomes really expensive as you get older, and a lot of people just end up lapsing it. This is as opposed to something called level premium. So level premium says, okay, we expect you to live for the next 30 years or whatever it is, and we will level the premium out over that time. Yes, you will have escalation and increases each year, but they will not be related purely to your age. They may just be cover and inflation related increases. So in this way, your 25-year-old self is cross-subsidizing your 65-year-old self. But and then since then, there's also been a further development. And a company, for example, like BrightRock was really, I think, the first to market with this product, which is really saying, well, let's do needs matched policies. And what that said meant was that we're only going to insure you for the period of time that you need insurance. And a great example, right? My kids, I take out life insurance. Some of my life insurance is earmarked for my children's education and to look after them if something happens to me. But I know that pretty much by the time they're 25 years old, they're not going to need that anymore, hopefully. So I don't want to have cover for my whole life that I'm paying an average premium for, and cross-subsidizing from younger to older and all of those things for something that I'm actually not going to need after a certain age. So they sort of say, right, here is a term insurance policy, so it's for a term period, and it ends at that term. Now, maybe in the case of Veli, he may feel, well, I never used it, and therefore I'm losing out because it does expire. But you've got to think of it differently. They will say, right, what's the risk of you dying over the next 10 years? And that risk is substantially lower, so therefore the premiums will be lower. So it is one way for you to really reduce your cost of insurance and make sure it's only there for the time that you need. But then I also have a policy because I want to make sure that I've insured my estate duties. So if something, when one day I pass away, which is not an if, it's a when, I want to know that there's enough money to pay out executive fees and all the other costs that come with death. So that one will be whole life. That would be carry on till I die. And that one I have as a level premium, so that I'm kind of cross-subsidizing now for when I get to my 70s and 80s. So those are just, some of the ways and questions that you need to be asking your financial advisors. What happens when this becomes unaffordable? Now, in Veli's case, he's got 2 options. One is he can go to his insurer and say, listen, I can't afford 3,000 Rand a month. Can I reduce my cover? So at least he's not losing, in his mind, all that cover if he just lapses it, but he can actually ask for the insured amount to be reduced and thereby reduce the premium. Another thing to consider is to ask your beneficiaries to take over the payments. So if you have this life cover and the whole idea of the life cover is to leave your children a legacy, for example, and you can't afford it, it may make a lot of sense for them to take over those premium payments. And I know some financial advisors have done the calculations and it works out extremely well. It's always an investment, I suppose. It's a little bit morbid because they're investing in your death to some degree. But at the end of the day, rather than letting that lapse, and as Veli says, all that money that he's put in all those years, if his children, for example, could take over those payments now, even take over a portion of those payments, as the beneficiaries, that could make a lot of sense for them. So these are just some thoughts I had for Veli. And again, but it does really highlight the importance of sitting down with your advisor and saying, right, how does this life insurance work for me? Should I be looking at term? Should I be looking at average premiums? And don't just go and tick the box for the cheapest premium, because ultimately there's always a cost to cheap. So if you want your question answered on the My Questions Answered video, please subscribe to the Maya on Money newsletter. You will find the link below.